Hello, friends. Today, we are going to talk about the history of the Indian stock market. How has been the Indian stock market journey and what does the future holds? So, starting with the share market, in the earlier days, the trading was done under the banyan tree. Our story starts not with the flashy stock exchanges of today, but under a modest banyan tree on Bombay's Dalal Street in the 1850s. Back then, brokers would meet informally to trade stocks of cotton textile mills, which were booming due to the American Civil War. What began as casual meetings eventually formalized, and by 1875, these brokers established the Bombay Stock Exchange, the first stock exchange in Asia. For many years, trading was done in person. Brokers used hand signals to make the deals, and prices were written on the blackboards. The brokers on the Dalal Street were like a close knit group with their own set of rules and traditions. The BSC, Bombay Stock Exchange, later came to be known as the Dalal Street, named after the area that became synonymous with the stock trading. The first IPO and birth of equity culture. In 1977, something monumental happened that forever changed the Indian stock market. Reliance Industries held its initial public offering (IPO). Before this, investing in shares was largely a playground for the wealthy, but Reliance IPO opened the door to the retail investors. It was Dhirubhai Ambani's brilliance that helped popularize stock market investments among ordinary Indians. He was a master at building trust with common people, inviting them to be the part of his company's growth journey. Reliance IPO was not just about raising funds, it marked the birth of a true equity culture in the India. With an initial issue price of rupees 10, Reliance share price multiplied several times over the years, turning early investors into the millionaires. The IPO attracted over 50,000 retail investors, a record at the time, highlighting how money changed the investing landscape. Now, talking more about the market, the era of the market manipulation. In the late 1980s, a powerful network of brokers worked behind the scenes, shaping the Indian stock market through something called Badla financing. This was an informal lending system that allowed brokers to trade stocks without paying upfront, giving them the power to take huge financial risks and influence the stock prices. One of the most influential figures was Manu Manik, who became known for targeting large companies like Bombay Dyeing by short selling their stocks. He could drive down prices, impacting the entire market. During this time, over 70% of trades were funded by Badla financing, leading to high daily trading volumes. Despite this, regular investors were mostly left out, with only a handful of brokers truly controlling the market. Then comes the 1990s, liberalization and the big bull. The biggest shift in India's economic landscape came in 1991 when Prime Minister P.V. Narasimha Rao and Finance Minister Dr. Manmohan Singh introduced the economic reforms. This move opened up the Indian economy to the world and brought an end to the decades of socialist policies. Foreign institutional investors began to invest in Indian stocks, injecting new life into the markets. The 1990s also saw the rise of the Harshad Mehta, the original big bull. Mehta's aggressive tactics and manipulation of the banking loopholes led to a market boom in the early 90s. But it all came crashing down in 1992 when his financial scams were exposed. It shook the market to its core and led to the creation of the Securities and Exchange Board of India, SEBI, to regulate the market and prevent such fraudulent practices. The importance of SEBI taming Dalal Street. In the aftermath of the 1992 Harshad Mehta scam, SEBI's role became critical. It was introduced to curb insider trading, prevent fraud, and regulate the market more effectively. SEBI began enforcing rules on insider trading and market manipulation, disallowing Badla in the early 2000s and introducing rolling settlements in 2001. By 2003, market transparency had increased significantly, with the average settlement reducing from 14 days to just 2 days exactly. This built trust among the investors and increased the market liquidity, and hence the SEBI's role we could have seen very successful. Changing the sectors on the Dalal Street was the next move. Different decades favored different sectors. In the 1990s, the market was continuously favoring the information technology sector, emerged as a market favorite, with companies like Infosys and Wipro delivering stellar IPOs. Infosys, which went public in 1993, became the poster child of India's IT boom. Its co-founder, Narayan Murthy, showed the world that a small tech startup in Bangalore could turn into a global giant. As the IT sector rose, other sectors like pharmaceuticals also caught the market eye. Sun Pharmaceuticals, Lupin, and Dr. Reddy's laboratories surged in the 1990s and 2000s as they tapped into the global demand for the generic drugs. The early 2000s brought another wave, the real estate and infrastructure boom. Investors were optimistic about India's rapid urbanization, and companies like DLF and Unitech saw their market value soar. However, the 2008 global financial crisis burst the real estate bubble, leading to a sharp correction in the market. Then, next was the year between 2011 and 2020. The market between 2011 and 2020 was a decade of transformation. The period between the 2011 and 2020 was transformative for the India stock market because the global financial crisis of 2008 has left a lasting impact. But by 2011, the Indian markets had started recovering. From 2011 to 2020, the BSE Sensex grew from around 18,000 points to over 41,000 points, nearly doubling in value. This period saw the rise of new sectors, a boom in consumer driven companies, and the deepening of market participation. During the decade, significant reforms shaped the market. For example, in 2016, the government's demonetization initiative removed the 500 rupees and 1000 currency notes, leading to the increased digital transactions and giving a boost to the fintech companies. In 2017, GST was implemented, simplifying the tax regime and benefiting sectors like logistics, manufacturing, and retail. In 2018, the Securities Appellate Tribunal upheld stricter SEBI guidelines on corporate governance, ensuring more accountability for listed companies. Retail investors also began to dominate the market during this period with a surge in mutual fund investment, which we are largely seeing in the form of SIP, systematic investment plans. It has contributed for the market and has crossed 8,000 rupees crore per month by 2019, reflecting a shift towards disciplined long-term investing by the investors. Then comes the Murat trading. One unique feature of the Indian stock market is Murat trading, a special 1 hour trading session that happens every year during Diwali. The practice dates back decades and is deeply rooted in the Indian culture. Diwali marks the victory of light over darkness and is considered as an auspicious time to start the new ventures. During Murat trading, the markets open for a symbolic hour in the evening. Investors place small trades as a gesture of faith in the future of the markets. Families gather, dress in their traditional best, and celebrate not just the festival of lights, but also the spirit of hope and prosperity in the financial world. On Diwali 2023, the 1 hour Murat session saw over 9,000 crore worth of shares traded, reflecting the optimism and positive sentiment prevalent in the market around this time. You can read more on the Murat trading on our YouTube channel, where we have discussed about the videos, how the market has been growing. Now, what is the road ahead? So we need to see that the market has been continuously growing, and there has been some ups and downs in the market, but still we can see that the SEBI's role and the market participation has been continuously increasing. So if you have liked our video, do share it with your friends and subscribe to our channel for more such insights. Thank you.